All right. Well, chapter 9. We're going to be as each of these chapters have been probably since chapter 7 or 8. We're now like going to deep dive on a certain topic that we've already kind of covered. In this chapter, it's going to be on plant assets. So if you remember back, we did talk about plant assets in general. Like in chapter 3, we talked about depreciation that's related to these kind of longer term assets. But now we're going to go deeper into that topic. Okay, so um, how we've talked about like historical cost, right? The historical cost principle. We're going to see now a little more detail on when we kind of acquire a property, plant, or equipment asset, how we calculate the kind of the capitalized cost, the total cost that we're going to have on our balance sheet for it when we first acquire it. Then we're going to spend more time on depreciation as a topic, refresher on what it is, and then we're going to learn some other methods to kind of calculate depreciation. We're going to talk about when you get rid of an asset, a property, plant, or equipment asset, where it like how to account for that disposal. Within chapter 9, we're also talking about natural resources. Okay, so this is another type of kind of like long-term asset that we have on our balance sheet uh, for things that we extract out of the ground. Okay, so let's talk about how to account for that. It's very similar to how we account for these, what we call PP&E, property, plant, and equipment. But there's a slightly different terminology and certain different topics related to natural resources. We've also talked about intangible assets to some degree, but now we're going to talk about kind of how to, it's not called depreciation, but like how to deal with those and how they may lose value over time, um, and the accounting related to intangibles. And then we have the asset turnover ratio. This is a ratio related to how uh, how well you're generating revenue with your assets. So we'll talk about how to calculate that, and then how to, uh, and this is kind of related to disposal. Okay, if you instead of getting rid of an asset, it's like when you trade in your car, right? You're trading one car asset for another. So this is an example of an exchange of assets. So we'll talk about how to account for that, and it's very similar to disposal. It's like there's certain specific topics related to exchange, but it's very similar. Okay. Um, so before we start this, what are plant assets? Let's just be clear about what this is. What are some examples of plant assets? Who can refresh the class on what some of these are? Anyone? Land. Okay. What else? What sits on top of land? Buildings. What else? Machines. Equipment. Okay, yeah. So all this stuff. Good. We kind of have a good idea. Land, building, equipment, furniture. Okay, this is another one. Furniture and fixtures, like in an office building. Automobiles, so all the vehicles that your business would use. Oops, so I doubled this. Repeat. Okay, so good. So we know kind of what these are. We remember. Um, and like beings, living beings, they also have a life cycle. Okay, so there's acquisition. There's so this is birth, right? Birth, usage, and disposal. So usage is like this is birth, life, and death. Okay. So each of these phases has its own accounting kind of issues. Okay. So during the birth of an asset, we have to figure out how much we have to first record this asset, what its value is on our balance sheet. Okay. So there's some obvious things like if you're buying equipment, how much you're paying the company to buy the thing, right? But there's other related things like transportation, taxes. So we're going to talk about what the specific details are on this birth thing first. Life, during the life of the thing, while you're using it, we've already talked about this topic of depreciation. So we have to somehow account for the fact that property, plant, and equipment assets, except for land, are kind of losing value because they're getting used up. These are things that have like a definite, like kind of, they get used up. They lose value over time, and uh, they head towards death. So you have to have some way of accounting for that usage. Okay, so we have this thing called depreciation expense that's trying to capture that. That's why for real estate, you're not depreciating the land, but all the stuff that sits on top of the land is losing value, right? If you have a house that you live in, the land is still the same, but the house is falling apart, right? Your house gets used up, and you have to replace stuff, and at some point tear it down and put on build another house. Um, and then at death, we'll talk about what to do when you sell the thing, if you just get rid of it, if you exchange it. So we'll talk about all that stuff at the end of the life of the assets. Okay, so again, I would, in my mind, just think of these assets like some kind of being, and they have these three phases, and you got to think about what phase your asset is in, and uh, remember that each of these has its own specific accounting topics. Okay, any questions on this? No? Okay. Okay, so let's talk about birth. Okay. So the main thing is the historical cost principle, where um, let's say we go to a flea market and we buy some piece of machinery that we pay $100 for, but we got like a stellar deal. Okay, and it's really the market value is like 500. Okay, we can't record it at that $500 value. We're going to start always with what we're actually paying for things. Okay, even if we get some kind of super awesome deal on something, it doesn't matter. Okay, if we bought that thing for 100 and we sold it the next day for 500, we would realize a gain. Okay, and that'd be good for us. But at the time you buy it, if you're going to be using it, you just really care about what you paid for it. Okay, we're not going to speculate, because until you sell it, it's all speculatory, right? You don't really know what it's worth until you actually have a transaction. So because we're trying to be conservative, we're always just going to focus on what we actually paid for the thing. Okay. Um, and it's also not just the sticker price of what we're paying. Okay. So if we paid taxes at the time of acquisition, if we had to pay some commission when we bought something, the cost to bring that equipment or whatever it is to our place of business, we're gonna also include that in the cost. Um, and even like, let's say we bought some machinery for our factory, we're gonna pay the company. Um, like, let's say we're a chip maker, okay? Let's say we're Intel. We're buying this uh, chip making piece of equipment from ASML. It's this company in the Netherlands. Uh, this is a little interesting side note. What are the most complex machines humans have ever built? There's some topic, like, there's some opinions on this, but what do you think they are? What are, like, just by cost? What is like the most expensive machine? Yeah. No. Nope. What is that? Okay, that's not quite a piece of equipment. Yeah, okay, okay, yeah. Not the chip itself, because the chips are quite easy. We have thousands of them in a data center. Yes. So one of them is this. Basically, now the chips, the transistors are so small, you have to be able to print these things at the atomic level. Okay. So to get a printer that's so exact that it could print these transistors, it's like now, like the complexity of it is just like crazy complex. So this company ASML, they make these basically chip printers, and they're like 300-400 million dollars just for one. Another one is an F1 car. Okay, these cars are like hundreds of millions of dollars. Okay, the technology and the complexity to them is like also just like, next level. And then rockets. I asked a friend, like an engineer friend, what he thought, and he's like, those like the SpaceX rockets that can land and stuff. That's also like, those are also very expensive. But yeah, the chip printer, like people don't think about that, but it's very expensive and very complicated. But yeah, so like let's say you're Intel, you bought one of those machines, it's going to be $200 million or 300 million. Then the cost to transport it from the Netherlands to wherever your plant is, Arizona, they're building new chip fabs there. And then the cost to install it, because installing that machine is also going to be very expensive because it's so complex. So all that stuff is going to be capitalized as the cost of this machine. Okay. Um, so everyone good with that? Everyone understand that that's going to be kind of your starting point. That's going to be the base upon which you're going to depreciate. So though you paid all this stuff as kind of separate transactions, you're not going to expense this separately. You're going to treat it as an asset up front and then depreciate it all over time. Okay? Yeah. 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 That's a good point. Yeah. Yeah, I'm sure there's some leeway on how this is set up. Like maybe some companies will capitalize that, some won't because they'll just have staff and they're going to expense it. So yeah, I think you as the accountant are going to have to make a call. If it's a very clear thing of like, okay, well, we hired these 5 people and the startup cost to get them trained just to get the equipment in a state that's usable, you could justify that to say like that's a startup cost, right? And then once it's ongoing, maybe there's gonna be turnover, and then you just expense the new salary. But this is just to get the thing started to actually be usable for your company. Yeah, but you're right. There's some leeway here. Management will have to have some discretion on how they account for it. This kind of weird stuff. Yeah. Okay. So again, this is all at the birth of the thing. Okay, this is all just to get the thing started and usable. The next phase is going to be life. Okay, so um, we'll talk about that in a second. But there's also like, especially for real estate, you can either buy land and then build a building or like a piece of machinery. Maybe you're going to figure out a way to build your own, uh, like kind of specialized equipment. So both are going to kind of be the birth of the asset, but there's some differences, right? So if you're constructing, and I gave the example of constructing a building, you're gonna capitalize all this stuff that goes into creating that building. So the materials and labor, architecture fees, contractor overhead, permits. So like, let's say you're building a house, the materials and labor is 500K, the architecture fees, I don't know, 100K, contractor overhead, another 100K, and then permits, 50K. When you first have this asset, it's going to be 750,000. Okay. This is going to be how much you record the building asset on your balance sheet for. Okay. And while you're paying these, okay, there's typically going to be like a placeholder account. So let's say you paid your materials, you're going to first have like uh, building in progress. Okay. There's going to be some asset called building in progress, which you'll debit, and you'll debit cash or whatever, right? And all this stuff will have the same journal entry. And at the end, your building in progress account will look like this, right? It's going to be 500, 100, 150. Okay, so this is building in progress. It's going to be 750. And then when your building is done, what you'll do is you'll get rid of the building in progress and have your building. So your journal entry will be building. and then building in progress. So 750 is the cost basis of this building asset, and your building in process goes to 0. Okay, so you've kind of just moved over all this stuff into this new asset with the cost basis of 750,000. Make sense? Yeah. Okay. And then buying the building, of course, is like much simpler. You're just gonna have some amount you paid, purchase price plus the tax commissions, and then also this one is a little kind of specialized thing. If you're having to do some major renovations to get it ready to use, or like if you're changing the use of it, like my like the gym I like go rock climbing in, it used to be a pipe factory. Okay, so the when the company that runs the gym bought it, it had to invest a bunch of money to convert it from that factory into a climbing gym. So all that is going to be capitalized as the cost basis of the building. Okay. And then once it's ready to use, right, for this is going to be the starting point to depreciate, the kind of the all-in cost. Okay. But up until that point, we're going to capitalize it. We're going to include it in the cost basis. Okay. Makes sense? Yeah. Okay. Good. Um, Okay, so why don't you try to do this problem? Um, we have land that we purchased, um, and there's several other costs that are associated with it. So just try to figure out what the journal entry is. Okay, so um, we'll use they have a pretty good formatted table here with all the relevant components. So let's just use this. Okay, so this asset that or this transaction is comprised of 3 assets: land, building, and equipment. And again, this whole whatever topic is called lump sum purchase, meaning that you're paying one amount for several different assets. Okay, and so these 3 things each have their own individual portion of this 130,000. We don't know that yet. That's what we're doing this exercise to figure out. But we, again, have an appraisal done, and we know independently, if we were just to separate each of those and kind of value them individually, uh, that they're worth 70,000, 56,000, and 14,000. And again, these are not like real numbers. We don't actually know that they're worth that much independently, because the only way we would know is if we took the equipment out of the building or whatever, put it on the market, found a buyer, and actually sold them. Okay, so when we do an appraisal, we're just speculating. We don't. This is just a estimate. Okay, but we're using the estimate as a basis upon which we apportion a real number. This 130,000 is a real number. We're actually paying that much. Okay, so this is again another example of using estimates in accounting. It's a very commonly done thing. We saw it with receivables last period where we estimate our allowance for bad debt, right? This is another example where we're using an estimate because a lot of accounting, you're trying your best to be accurate, but you can't predict the future. You can't know the exact market values of things, so you end up using uh, estimates a lot. Okay, so if we add this up, we see that the total is 140,000. So based on this, did we get a good deal or a bad deal? Raise your hand if you think we got a good deal. Yes, we got a good deal, right? We paid 130,000 for allegedly $140,000 worth of stuff. So we got a discount. Okay? So Now we want to figure out the portion of each of these based on this total fair value. Okay, so uh, there's a Excel kind of function you can use to do this, or like a little method here. So you want basically the formula to go downwards, but you want $140,000 to be fixed in place. Because if you just had everything shift one down, you'd have this. You'd have at first you would have 70,000 divided by 140,000. So this would be okay. But if we didn't do something, watch. Now it shifted everything down one. Okay, we don't want that. We want the pink one to be fixed on the 140,000. Okay, so what we can do is put these dollar signs around the pink one. Okay, and I did that by pressing F4 right next to it, like right next to where the cursor was on the red uh, cell reference. I pressed F4 and it put these dollar signs. Okay, so now Excel knows to keep the red one fixed in place. So now when I apply it downwards, you can see that it moved the blue, but it didn't move the pink. Okay. So now we have these, and I'll format them as percentages. We have these percentage, the proportion of each of these three based on the fair value. Now we're going to apply that to what we actually paid. We actually paid 130,000. So I just multiply percentage times what we paid. Okay. And the check to make sure this is correct is that this should sum to 130,000. And it does. Okay, so now we are ready to do our journal entry. We know how much each of these three assets is going to be kind of put on our balance sheet for, what the account balance should be, the starting balance, our cost basis for each of them, you can say, and we know how much we paid total. And it says that we bought this with the note payable. Okay, so I can just take these three accounts and I have notes payable as my credit, and the note payable is 130,000. And then I can just copy and paste, or maybe I'll use cell references. Okay, that's the journal entry. Okay, any questions on this? Everyone good? Again, the 140,000 is just an estimate. We just had an appraisal done. We wanted some way to figure out how to apportion this 130,000. Now, are these percentages exactly right? No, they're not, because again, these fair values are just estimates. But it is at least a systematic way to try to do this, right? Um, so yeah, so this 140,000 is not a real number. It is an estimate. Okay, any other questions? Okay. All right, why don't we take a little break and we'll start up in a couple minutes. Okay, so we talked about the birth of the asset. Um, in this, this part here. What the heck? I don't know why this is not working. Okay. Um, okay, so now we're going to move on to the usage. Okay, so this second stage where we've bought the asset, we've put it into place, and now it's living out its useful life. How do we account for that stage of its life? Again, we have this. Well, before we do that, let's First, differentiate between capital expenditure or expense. Okay. Um, is this really not work? Okay, there we go. Okay, so um, during the life of the asset, the company is going to spend money. Okay. Uh, Depreciation, as we know, is a non-cash kind of expense that we take, but we will spend money on our assets. Okay, so we want to first talk about that before we talk about depreciation. Now, why are we spending money? For two reasons. One is to maintain our assets. So if we have vehicles, we got to do oil changes and fix the tires and fix all the stuff and just keep everything maintained. So we're going to spend money on that. Another one is sometimes we're going to upgrade our assets. We're going to uh, invest money to extend the life of the asset. Okay, so these two things are going to be treated differently when we account for them. Maintenance is going to be expensed. Okay, so as soon as we spend the money on the oil change, we're going to show that as an expense on our income statement right away. Okay, because it's not really contributing to the value of the asset. It's just to maintain the asset. If we upgrade or do something that extends the life of the asset, we're going to capitalize it and then depreciate it over time. Okay, so uh, an example or examples of capital expenditures, meaning let's say we spend $1,000 on this major engine overhaul. Instead of taking an expense of $1,000 in the period, we're going to capitalize it, meaning we're going to include it in the vehicle asset, and then maybe only take, if it's a 5-year thing, maybe take $200 of expense per year. Okay, and basically split this over 5 years. Okay, the expense of it, because it extended the life of the asset by 5 years. So we want to match the value that was added with the periods that it benefited. Okay, well, let's say we spent $1,000 on just repairs. This is going to be expensed right away. That $1,000 is going to come out of, it's going to be an expense on our income statement, and that full amount is going to be expensed. Okay. Um, so all these things, these expenses, these are going to be expense. Things like addition of capacity. If you modify the use, so like if you have a van and you're a locksmith, and you're like, okay, well now I want to get into plumbing, and you kind of reconfigure your van for that, that's all going to be capitalized. And then the expense of doing that is going to be split over however many periods you use the van from then on. Okay, is this clear? Everyone good with the concept between when you capitalize versus when you expense? Yeah. Okay.
Company has to have a structure. What's gonna be identified as a expense versus like if they buy like something cheaper, like $500 shelves, right?
Yeah.
They have to make a decision if it's like one-time expense
Yeah.
or utilize it in
You're right. You're right. So I think it will largely depend on materiality. Okay, if it's literally like if you're like some big corporation, Boeing, and you bought like $500 worth of shelving, you're probably going to expense that because it's so immaterial to your business, right? But if you're building a new facility, then you're going to capitalize that. Or if you're doing a major overhaul to your assembly line that's costing you hundreds of millions of dollars or whatever, you're going to capitalize that versus expense it. So I think materiality will also be a big part of this too.
So it's just
Yeah.
needs.
And of course, the auditors are going to look and they're going to say, hey, what did you capitalize versus expense? Because look, there's a big game. This is kind of relevant in their current time. Uh, there is a big game being played with AI, okay, with these data centers. Okay, what the companies are doing is, let's say it costs $10 billion. And I was talking to a guy at this wedding. He works for a big Japanese bank, and he works on kind of their. He's like a he looks at the loans that the bank makes, and that bank. It's like I think it's the largest bank in Japan. Um, they're doing a lot of this financing for AI data centers. Okay, so we were talking about this. So let's say it's $10 billion for the real estate and for the facility. Okay, that's one part of the data center. What's the other big part of the data center that's not included in here? Why is Nvidia like such a hot company? Yeah, the chips. Okay, so this is just to build the thing, put the racks, put all the electrical. Maybe it's going to be another 10 billion for the actual chips. Okay, and the actual computers that are going into the data center. Okay, so what the companies are doing, and this is you can say a financial scandal waiting to happen. I'll tell you about another one. But what they're doing is they're taking this 10 billion, and maybe all these facilities, it's kind of real estate, so they have a standard, I don't know, 10-year depreciation. But for the chips, which is as large or larger expense, they're maybe doing it over 5 or 7 years, let's say 5 to 7 years. Now, how often is Nvidia coming out with some new GPU that they're trying to hype up and sell to these companies? Is it every 5 years? Every like 1 or 2 years, maybe within 1 year, they have multiple chips. Okay. So the actual obsolescence life of these chips is far less than 5 to 7 years. So if it was, let's say 5 years, how much expense are they going to take per year? If we assume straight line, 2 billion, right? 2 billion a year. Everyone agree? If we had 10 billion of expense, it's going from 10 billion to zero over 5 years. It's 2 billion a year. Okay. What would be the expense instead if we were more realistic that this 10 billion becomes like obsolete in 2 years instead? Then what is the expense that we should take? 5 billion. Okay. So these companies are potentially, you could argue, uh, overstating their profitability because they're taking a much smaller expense for the chips than the actual amount that they should be taking. Okay. So this is financial scandal number one, potentially. The second one is a lot of the data centers are being financed off balance sheet. Okay, so what does that mean? So let's say you're Google, or actually use OpenAI because they have no other business than AI. Okay, Google has existing other businesses. They will partner with some data center company. So this, it's listening. I think it's because I said Google. Okay, they'll partner with company X. That is a data center company. Data center company X has no balance sheet of their own. Okay, they kind of exist. There's some entity that's set up. OpenAI will say, I will guarantee for 10 years, I'm gonna buy CPU capacity. Okay, it's a contract that they guarantee with company X, and so OpenAI is not actually gonna own the data center. They're just providing this guarantee of purchase. Okay, company X is gonna go to a bank and be like, hey, I have this agreement with OpenAI for 10 years. Okay. And the bank is like, okay, well, OpenAI is this great company, and they're saying they're going to guarantee revenue for 10 years from this data center company. So we'll give them a loan to build a data center. Okay. So now a bank will come and give, whatever, $20 billion of, I'm just using kind of fake numbers here, but they'll give a loan for $20 billion, assuming that company X is going to have 10 years of revenue from OpenAI. Now, what if OpenAI, they kind of lose to Gemini and Claude and all these other competitors in the next 2 years? Because it could happen, right? This battle is already playing out. What's going to happen to this loan? It's something bad, okay? Because this guaranteed, what the bank is thinking is money good. This 10-year guarantee is not necessarily, okay? Because this battle is playing out big time, and you can argue OpenAI is losing it, okay? And they've done a lot of these kinds of contracts. So though OpenAI doesn't own the data center, a lot of data center financing is centered on OpenAI. Okay, so all this stuff, we're gonna see how it plays out because it's probably gonna somewhat get ugly. Okay, because a lot of billions and billions and trillion, into the trillions of dollars have gone into this stuff, and that's like a huge amount of money. So we're gonna see. So again, uh, understanding the accounting because a lot of tech people don't understand this, but this guy's like a finance bro, and like so we could talk about the numbers, and so I'm hoping you all will also be able to understand this because this is really important. This is what actually determines like the cycle of all this stuff, how the money is flowing, profitability. Um, this is like kind of what runs the machine. Yeah,
I probably did not understand what you said. This is off.
off balance because OpenAI they don't have any loans or they don't have a data center asset on their balance sheet, right? Company X does, right? Company X is going to have, they're the owners of the data center. But indirectly, OpenAI is kind of the owner because they're guaranteeing that they're kind of like, they're the reason why Company X was able to get the financing because this bank was like, okay, OpenAI is going to guarantee 10 years of revenue.
By using their data center.
Exactly. So OpenAI on their balance sheet doesn't show a data center, right?
So they're like contractors for.
Yeah. So how they do this, because now the accounting standards do require, if you have a lease obligation, which is essentially what this is, this 10-year guarantee, you're kind of like, it is an obligation for your business, right? There should be a liability there because you're paying for something, but you're getting something too. So what the accounting for this, and I don't know how they're getting around this, it should be something like you're getting what is kind of like a prepaid asset, prepaid capacity, let's call it. Okay. You have the benefit of 10 years of this data center capacity. So let's call it 10 billion. And what you have is a lease obligation as a liability. This would be the journal entry that you would expect. Um, So you would have an asset of this 10 billion prepaid capacity. But somehow they're getting around this where they're not having to do this. Okay, and I don't know how. There's the accounting if you have to if you're guaranteeing it, whether you can cancel the lease or not. There's probably some technicalities where you don't have to do this journal entry. Okay, and plus OpenAI is a private company, so we can't even see their balance sheet, and they're taking advantage of that too. Because if they had to adhere to GAAP and like produce audited financial statements for the public, then they'd probably have to do something with this, and they don't want to. Okay? Yeah.
Wouldn't it be in the best interest of both like Company X and the bank giving the loan to evaluate like the authentic value of this proposal, like 10 years of profit?
It's very hard to say who's going to win this AI battle. And this guy I was talking to, this banker, when I was at this wedding, he knows this is all scheme, okay? Or it's like very risky. But he is just a guy working at a bank, and all the banks have to participate in this mania, or else they're gonna like they could look dumb, if they're like too conservative. So it's amazing how much of this stuff is driven by herd mentality. Okay, this guy is smart. He knows that this is very risky, but his incentives as an employee of this bank and the bank's incentives as a competitor in this kind of market of banks is to do this. It's like you can't sit out. If you sit out and it turns out that this works well and the banks that did do this are super profitable because of it, you're going to look dumb and you're going to get fired. Okay, so the incentive structure of this system we have is also not perfect. Okay, it incentivizes this kind of mania.
But they could still invest, but make sure the deal is like as valuable as it claims to be.
I agree, but it's like to go on a contrarian take and say OpenAI is like sucks. That's like a very contrarian view to have. Um, and if you're wrong about it, you're gonna get fired. If you're right about it, I don't know, maybe not much upside for you, you know? So it's just the institutional incentives are like not very strong for being contrarian on things. There's a huge incentive to just pile on to whatever the hype is.
Even just hesitating, they take the time to like
Yeah,
work,
yeah.
like get on that.
I'll tell you what the real solution to this is uh, being the principals, meaning the shareholders whose money is actually at stake. They're the ones making the decision. That's the only way that this whole, if you have like an employee who has only upside if things work out to be making this call, they're not gonna protect your money like you will protect your money. And that is a big flaw in our system. We have the principal agent problem has it's like it's so you as an employee at a bank or whatever is so separated from the shareholder, and you're only thinking about your individual incentives. You don't have skin in the game. And this is a big problem with especially our banking sector, like the finance sector. Okay. Okay, but we're gonna get data centers. Like this mania in the 2000s was for fiber optic cables. There's like a very huge mania like this that they over put in fiber optics. Okay, the all the infrastructure for the internet, they overbuilt it. A ton of companies went bankrupt over it. But later, all that stuff got used. So we're gonna get something. So there's gonna be losers. There's probably gonna be banks and like financial companies that get screwed over this, and OpenAI potentially. The investors in that. But we'll get something for it. We're gonna have all these data centers, and there will probably at some point be a big use for them. But are they financially viable right now? You could argue no. A lot of them. Okay. So let's go back to what we were talking about. Okay, so um, just an example of a capital expenditure. So in this transaction, we're spending $3,000. Now we need to determine, is that 3,000 going to be expensed or capitalized? Okay, so we have to see what it was for. Was it for maintenance, or is it to extend the life or extend the capacity of the asset? So we see here that it was to rebuild the engine. So that's going to extend the life, obviously, right? That's not just a regular maintenance item for the engine. If you rebuild it, you're going to increase the life of it. Okay, so that's why you can see here that we're going to capitalize it into this asset. This is an asset account. It's not an expense. We could have, if it was $3,000 for doing an oil change or changing the tires, this would not be truck. It would be maintenance expense. It'd be some expense account. Okay. So again, this determination, whether it's a capital expenditure or maintenance, it's going to affect how this is going to appear, whether it's going to be capitalized and become part of an asset on the balance sheet, or it's going to be expense, and it's going to, again, flow out of equity. The owners are like, if they wanted to maximize how much profit they're showing, they're going to try to avoid expensing things. They're going to try to capitalize things. And that's what we saw with the chips. They're trying to kind of keep more things on the balance sheet than expensing it. Like we saw the discrepancy, $2 billion of expense versus $5 billion of expense, depending on how much you're keeping on the balance sheet and spreading it out over time. Okay. And then again, if you have, instead of that money is spent on maintenance, you're going to have some maintenance expense, and you're going to have kind of cash going out. And this again will come out on the balance sheet. It's going to reduce your equity faster than if it was capitalized. Okay. Okay. So let's just do this slide. I think it should be review. Um, so what is depreciation? Again, when we buy property, plant, and equipment assets, uh, we buy them at one time, but they're going to be used over various periods. And so for our matching principle, matching we want to match the cost of the property, plant, and equipment asset with the periods that benefit it. Okay. You can also think about it that the value of the asset when you purchase it is going to decline in value over time because you're using it up. Okay. So however you want to think about depreciation, they're both kind of right in their own ways, but really we're trying to spread that expense over the periods that benefit. Okay. Um, Again, matching principle. What we do, the solution is that we capitalize the asset as we saw in that first part. We take the purchase price, the transportation costs, the taxes, all the stuff up front. We treat that as an asset when we first buy it. And then that's the basis upon which we're going to depreciate. Okay. So, this expense over time is called depreciation expense. Remember, it's a debit normal account, just like every expense. And we don't directly credit the asset account because, let's say we bought our van for 50K, we have depreciation expense. Let's say we're going to do this 10K every year. Sorry. So let's say after 3 years, this is year 1, 2, and 3, we could do this, okay? And on our balance sheet, show the asset worth 20K, right? Everyone agree? We want the van to show up as 20K, right? But we don't directly credit van. What do we use instead? What was the account called? Accumulated depreciation, van, okay? So we move this to another contra asset account called accumulated depreciation. And it's going to contain 10, 10, 10. Okay, and actually, sorry, this is kind of wrong because in year 1 it'll be 10,000. Okay, and then in year 2 it'll be 10,000. So each year of depreciation expense is just 10,000. Okay, but it accumulates here. Okay, everyone, this should be review chapter 3. Everyone good with that? Okay. Um, okay, and I think this is review 2. Let's just finish this. We have 4 minutes left. Okay, so uh, what do you need to calculate depreciation? There's 4 elements. Okay, you need your acquisition cost. So this is from that first stage of life, that birth of the asset. We're going to have that as our basis. Okay, so we need to know what our starting point is. We need to know how long the asset is going to be used for. And again, there's physical life and there's kind of useful life. Okay, so what we're looking for is a useful life. So for the chips that we talked about, maybe the useful life is only going to be 2 or 3 years. Okay, even though those chips are useful, like in a car, I think the chips that are in cars right now are like designed, 10 years ago or 15 years ago. Okay, so those chips are probably useful for something, but for AI and the cutting edge kind of use that they're being used for now, maybe they're only going to be good for a couple of years before there's something better that you need. Okay, so it's going to depend on, again, the useful life, not the total life of the thing. And then what it's worth at the end. Okay, because again, like the chips, after 2 or 3 years, they're not going to be worth 0, right? They're going to be worth something to somebody. So we have to estimate what that's going to be. Okay, and that's called the residual value. And then the fourth is the method. Okay, so if we put this all onto a table here, or a graph. In this hypothetical, number 1, we start here at time equals 0. So the x-axis is time, y-axis is money. Number 1, the starting point at t equals 0 is this acquisition cost. Number 2, the estimated life is this point in time. That's our useful life. Number 3, okay, at this 7-year useful life, what is it worth? So this right here, or this, you can say, number 3, is the residual value. And then all these, we have various lines that link them, okay? This white one is like you just depreciate all of it, and then you just, you're kind of there. You can have a nice steady curve here. You can have a straight line. You can have this zigzag, like as long as it goes from here to here, you know, it's going to be like you could justify it, okay? So we have to pick a method, though. We have to figure out what method we're going to use to connect those 2 points. Okay, and that's the depreciation method. And there's going to be various of them because, again, this pink one here, or this, I don't know, peach, that's straight line. That's where you split up uh, the difference from here to here evenly over each period. This one, where you take more and then it kind of flattens out, is like an accelerated depreciation. We're taking more expense in the earlier years and less in the end. We still get to the same, it's like from the same starting point and we're getting to the same ending point, but we split up that kind of that difference unevenly. We've taken more in the beginning, okay? And then, you can even argue that this one is accelerated, where you just take all of it in the first year and then, whatever. So that's like really accelerated. And that's actually for tax purposes somewhat common. You take the total amount in the first year and then none for the rest of it. Okay? And that's beneficial because you can offset a lot of income for taxes, right? So if you made a lot and you are able to depreciate a lot against that, you end up paying less tax. That's why people, especially in real estate, accelerated depreciation is like, there's a lot of ways to do it. So, and sometimes the government will give, like, some company, like, hey, if you invest $1 billion to build this oil refinery, we'll let you expense it for tax purposes right away. And that's good for them because they can offset their income using that. Okay, all right. So we'll pick up with this on Wednesday.